Hey everyone, welcome to On the Market. This is Dave, your host. Today we are going to be joined by one of the OG data and market media people in this entire industry. His name is Clayton Collins. He is the CEO of HousingWire Media. If you're not familiar with HousingWire, they're one of the biggest housing market media companies in the industry. They don't focus really on investors, sort of like we do here at Bigger Pockets. They focus on the broader marketplace. So, mortgage lenders, real estate agents, a lot of those types of things. But Clayton and his team, they have been acquiring data companies actually over the last couple of years. And so they have some of the most cutting edge data of any of the sources out there. And so today I'm having Clayton on to talk to him about some recent changes that we've been seeing in the market. So inventory, as you all know, is a really big issue this year, and they have some of the most up-to-date information about that. So I'm eager to talk to him about if there's a shift going on as we go into the winter, because I'm starting to feel one or sense one, and I'm curious to see what he's seeing. We're also going to talk about Clayton's predictions for mortgage rates. And I know this is something people really want to know. So I'm going to talk to Clayton and get his opinion about where mortgage rates are going to go and why. And I know we all like to prognosticate, but there are some really important macroeconomic trends and sort of technicalities that go on behind the scenes that Clayton knows a lot about and is going to help share with us today. So that's what we got for you today. It's going to be an awesome show. It's a lot of fun. Clayton is really great at explaining some really important topics in the housing market. So we're going to bring him on in just a minute here. But first, we're going to take a quick break. Clayton Collins, welcome to On the Market. Thanks for being here.
Dave, it's my pleasure. Thrilled to be your guest today.
Well, yeah, this is going to be a lot of fun. For people who don't yet listen to the HousingWire podcast, can you tell us a little bit about yourself and your work at HousingWire?
Yeah, happy to. So I'm the CEO at HW Media, where I have the pleasure of leading our HousingWire team. At HousingWire, we're focused on providing housing professionals from real estate brokerage and agents to loan originators and mortgage capital markets leaders and loan servicers with the full picture of the housing economy. So we have a team of editors and reporters that cover everything that happens in housing, from housing market and interest rate news to the movement of people and companies and M&A and innovation, everything that happens in housing. And I came into this venture, and I'll tell you more about my background, Dave, more as a banker type, but somehow I got sucked into hosting a podcast, and now I'm the host of the Housing News Podcast. So each week I interview different executives in the housing industry, from mortgage bank CEOs to economists, about what's happening in their world. We kind of keep it like a board level conversation and talk about kind of some of the tougher topics that they don't always get to talk about. And I try to pull out some of that juicy knowledge in this really fun format that I think you and I have both grown to love.
Oh, for sure. Yeah. And it's a great show. I do listen often. And you do get excellent guests. So definitely recommend it.
I appreciate it.
One of the other things you didn't even touch on, and I've been following HousingWire for many years, is that recently you acquired Altos Research, and we have had their founder, Mike Simonson, on the show, and he and I are friendly as well. And now you guys are tracking some of the most up-to-date housing market data, honestly, there is, that I see. Can you just tell us a little bit more about what you all are looking at?
Yeah. So Dave, I appreciate you asking about that. Altos is an important part of that phrase I use, the full picture. So we believe that business news and business content is on a constant evolutionary cycle that's leaning more and more toward data-enriched content and research and proprietary information, and narrative-driven journalism and storytelling is an incredibly important part of a data-rich ecosystem. It's how professionals consume information. But we know for us to achieve what we want to achieve at HousingWire, by being the full picture, we need experts like Mike and data like we get from Altos to really color that picture. Altos tracks 100% of active listings in the country. So we like to think of Altos as the most real-time source of data for what's happening in the active real estate market. So we're watching every active listing, every price change, every pending, all the data that drives market intelligence. And our users, which are primarily real estate agents, title professionals, and loan originators, use that information to better inform their home buyers and sellers and referral partners. So we take all this active market data and kind of decipher it down and cleanse it and make it understandable so professionals at the local level can be the expert in their market and know exactly what's happening in their zip code or their city or their neighborhood. And we have some really cool visualizations of data and the health of the market. We call it the Market Action Index. And we bring all of these tools directly to the professionals that are working with home buyers and sellers every day and make it easy for them to understand what's happening in housing.
Yeah, great. I mean, I totally agree with the value proposition. That's the whole idea behind the show as well, is that we need more narrative, data-driven information in today's world. And you guys are doing a great job at it. And just for anyone listening, you can check it out. A lot of it's just available on HousingWire. You can go check it out right there. But tell us, Clayton, what are you seeing right now? Because inventory has really been the story of the year. It's the word of the year in real estate, I guess. But things are starting to look a little different as we're heading into Q4. What are you seeing?
Yeah, I mean, it's been an incredibly, I don't want to use the trite term of challenging market. It's been a complicated market, Dave. So over the last year and a half, we've seen mortgage interest rates grow at a faster pace than we've seen at nearly any time in history. And we're at a point right now where interest rates are at 20-year highs. And that creates some really challenging dynamics in the market. And in most environments where interest rates expand this quickly and reach multi-decade highs, you'd start to see some serious pain in the underlying asset, and you'd start to see home prices decline. But there's this other dynamic, and it's that word that you just mentioned, inventory, that's made this challenging market more so of a complicated or complex market. So depending on the research you follow and the analysts that you trust, there's a view that we've been underbuilding in the U.S. for at least 13 years, and household formation has far outpaced new inventory coming to market. So we have this demographic push of first-time home buyers and people that are forming households that are creating demand in the U.S. Housing economy, and we just haven't kept up. And that undersupply has created an inventory constraint. And despite the pressure with mortgage interest rates, we've seen home prices hold up. In most markets, home price appreciation has continued. And it creates this really unhealthy dynamic where first-time home buyers, repeat buyers all face affordability challenges finding the home that they want. And it creates a pretty funky scenario in the residential housing ecosystem.
Yeah, definitely. I mean, I think we're all sort of getting used to this low inventory situation.
Yeah.
Like, do you see anything in your data or just in your own opinion that would increase supply? Because, we talk a lot on the show about demand because that seems more variable, but I'm having a hard time. I've been asking a lot of guests this, do you think anything will change the supply picture through the end of this year, maybe into 2024?
Do you want me to hunt for silver linings or?
Sure. Do whatever you want to do.
No, I think the reality is I do not see a dynamic that changes the inventory or supply situation drastically in the foreseeable future. I think we're looking forward at a multi-year, potentially multi-decade market where we operate in a lower inventory, lower supply constrained market. Now, we know coming out of COVID in a market that moved incredibly quickly to the upside in terms of volume, and then now this interest rate increase, that year-over-year metrics are hard to track, and there's going to be noise in like every measure where we're looking at month over month, year over year, even normalizing for COVID. There's a lot of noise in year-over-year metrics. So today, as we sit and fall of 2023, we're watching the Altos research data, and we're seeing that inventory today is still 5% lower than inventory of last year, despite the fact that we've been watching inventory increase each week for the last several months. So like we start to see this trend where more inventory is coming available, and that's coming available because days on market is extending. So homes are not moving as quickly as interest rates approach this 7.5%, 8% range. So homes are sitting longer. So inventory is building. Now, the easy headline there, the housing bear, the bubble boy persona, as our analyst Logan Motoshami would.
We're big fans of Logan. I love Logan. His terminology is hilarious.
Yeah, he's a genius when it comes to colorful terminology. Some of the players in this housing ecosystem that we operate in. But so the bubble boy mentality would be like, oh gosh, we're looking at like multi-months where every single week inventory is climbing. Like this is a problem brewing, but we're still sitting at a place with 5% fewer homes than last year. And I'm not armed with the data as we come into this conversation, Dave, but we're significantly lower than we were at almost every point pre-COVID in terms of what normal housing inventory levels look like. So like, I'm going to warn you right now, someone's going to write a headline and saying like, inventory is climbing, home prices are getting slashed, we're heading into a bubble, a turbulent market, it's all going to blow up. Our data does not show that. We show that we are climbing, but we're climbing back toward a slightly healthier place, slightly healthier, but we are still in a savagely unhealthy housing market. And that unhealthiness is fueled by low inventory and affordability challenges that are complicated by mortgage rates and home prices.
Yeah, I think it's super important for people to pay attention to not just the percent change, but the absolute numbers when they're looking at some of this data, because there is something, as we've gone over on this show a little bit, is that there's something called the base effect. When you're comparing, this year to an anomalous year like last year, then data looks a little bit crazy. But if you zoom out a little bit and look over 5 years or 10 years, you can see that historically inventory was much higher than it was even today, even though it has started to increase. Now, this is a good segue to one of the things I wanted to ask you, because in certain markets, we are starting to see inventory approach or even exceed pre-pandemic levels. And these are some of the, COVID boom towns like Boise and Austin, I think Vegas and Reno, or, those profile. But some of those markets have actually been okay over the last few months, even though they were previously in a correction. Do you see any change in demand or any downward pressure on prices in those markets?
Yeah, so we published some research based off of data from CoreLogic on some of the markets that are most likely to see a price decline, Dave. And what we're seeing in that data is that there's different drivers in all of those markets. So there's markets like in Ohio and Pennsylvania that are being driven by kind of lack of population growth and lack of job growth. And then there's markets in Florida, or like, as we think back to the phrases of the last crisis, the sand states that just saw rapid appreciation in prices. And it's more so of a normalization than a normalization will still like sit significantly higher than like the base rate of pre-COVID. So there's different drivers on like what we're seeing in each market. I think we saw a lot of exuberance and over ask offers in certain markets that were really popular during COVID, particularly in states that had, kind of a better lifestyle, more lax, enforcement of, some of the COVID restrictions, no state income taxes, like the things that attracted people over the last couple of years. And, some of those states are going to see a slowdown in home price appreciation, and certain markets may even see some declines in prices. But, I think it's hard to quantify those as like bubble markets or crisis areas. It's just a volatile pricing ecosystem that saw a fast run up and is trying to find the equilibrium point.
Yeah, it's weird because it feels like there was this correction, at least on a modest correction on a national scale. It was more pronounced in these types of markets. And, about a year ago in Q4 of 2022, maybe into Q1. And then things got better, at least from a price perspective, if you're someone who wants high prices. I think certain investors of our investors don't want high prices.
No.
And now it feels like, and things got better. And I think a lot of people are starting to think, all right, we found a bottom. To your point, there's like this pricing exercise that's going on. Like, what is real? What was COVID exuberance or this like massive change in migratory patterns? But now it feels like we're going back, like to me at least, it feels like we're going back into the pricing exercise because rates just won't slow down. And like now we're like accepting, I feel like there's in the last 2 or 3 months, there's finally market-wide acceptance that the Fed is not bluffing and that they're going to keep rates higher for longer. And we need to all deal with this. And now there's going to be this sort of second pricing exercise that goes on.
And let's not even call it a pricing exercise. Let's call it the way markets are supposed to operate.
It's true. Yeah, that's literally a market.
When cost of capital goes up, like there's pressure on asset prices. And if specifically, and so we primarily look at the housing economy through the lens of the residential homeowner. And I know the Bigger Pockets audience inclines much more toward the investor category. So it's a different lens, and there's a little bit of different analysis that goes into the right time to buy or sell, whether you're looking for a roof over your head or an asset that produces yield. But the secret on the investor side is understanding the national headlines, and that over the last 12 months on a national level, we've still saw close to 4% national home price appreciation. Over the next 12 months, we expect 3 to 3.4% home price appreciation. But where are the deviations from that? And like the article that you spotlighted and asked me about of where home prices are supposed to fall, that volatility, I think, is where like opportunity will be found. And this interest rate environment definitely puts pressure on pricing standards. And I think that does create an opportunity for home buyers and investors alike. I'm not sure we're not gonna preach the marry the house, date the rate thesis, but like you do have to think about like winter market environments when it's a good time to buy, winter market environments when it's a good time to hold, and high cost of capital markets often create downward pressure on asset prices, which something I'm paying attention to.
Yeah, absolutely. That's a very good point. And I'm curious, you said what, 3 to 4% growth over the next 12 months, is that right?
Yeah, we're talking about the CoreLogic home price article. So I'm like hinging on their estimates. There's some pretty wide estimates. I mean, we still have investment banks that are forecasting negative home price appreciation, but most of the housing economists that we're watching are like kind of looking at that 3 to 4% range on a national level.
I'm curious, it must all be on rate declines, right? Like I guess I just don't see how prices keep going up personally unless rates fall. So they must, and there's a good chance rates do fall next year. I'm just saying like that must be why.
Great qualifier there, Dave. I think every housing economist that I am following is forecasting lower rates by the end of 2024. Now, wishful thinking, optimism, fact. I don't know.
We don't.
I think every like long-term interest rate forecasting is a fool's like game, and there's no win so there. Hard. And
just when we were like starting to settle in the mid sixes, everyone was starting to get comfortable with it. Then bond yields just started going crazy in the last month. And it's like, no one even really we've had good jobs data, but like no one really even fully understands why bonds have just run up. There's this huge sell-off going on right now.
I mean, a big reason why like mortgage bonds are like the spread is so wide is the Fed's not buying.
Yeah.
I mean, we have a long-term, like look back at the last decade, spread between the 10-year and 30-year fixed rate mortgages was 130, 140 basis points. We're sitting at 300 right now.
Yeah.
And that is because of the Federal Reserve. Like the Federal Reserve is not just controlling interest rates. They're also controlling the throttle on buying mortgage-backed securities. And that's creating incredible pressure in the capital markets ecosystem, which arguably is more impactful on the price that consumers and investors are paying for debt than even some of the interest rate moves. So like the Federal Reserve is having a big impact on spreads right now. And that's something that can be fixed. Like if we start to see a normalization of mortgage-backed security buying, if the bond market starts to operate as it should, and banks and the Federal Reserve start coming back into the market and buying mortgage-backed securities, we're going to see a massive change in the 30-year fixed rate mortgage for the better.
Yeah.
But right now, you want to know who's buying mortgage-backed securities? Nobody. Like it is a dead market, and that's creating a really big spread.
Yeah. So just so everyone understands what we're talking about here, just if you're not familiar, mortgage-backed securities is basically when people, bundle a bunch of different mortgages and they're sold on markets to investors. And for much of the last 15 years or so, one of the biggest buyers of mortgage-backed securities has been the Federal Reserve. As part of their effort to do quote unquote quantitative tightening to reduce the monetary supply, they are reducing the amount of bonds of MBS, mortgage-backed securities, that they are buying. One of the major drivers of mortgage rates, as Clayton just alluded to, is the spread between the 10-year yield and mortgage rates. And normally, like you said, it's about 1.5% or 150 basis points. Now it's about double that. And the spread is due to a lot of different complicated things, but one of the main things is demand for mortgage-backed securities. Like that is a major driver of the spread. And as demand goes down, prices for these mortgage-backed securities go down, and that sends yields and interest rates up. So hopefully that makes sense, but I totally agree with you, Clayton, that is a very complicating factor in this entire scenario. And maybe one of the reasons for optimism is that rates will come down, because mortgage rates could come down without the federal funds rate falling.
What happens if mortgage rates start to come down? Demand on MBS we anticipate will pick up. And so at the same time as rates coming down, the spread will narrow, and rates will come down even faster. So one of the reasons the spread is so wide right now is because who wants to buy a tranche of mortgage-backed securities at a 7.5% or 8% rate? Those loans are going to get refied so fast. So investors need to get paid off quickly. So they're demanding there's pricing pressure on the mortgage-backed security portfolio, because the loans are going to get refied the second we see a change in interest rates. So the owners of those mortgage-backed securities need to get paid fast. In the first year or two, they need to make their margin on the security. And that's one of the other reasons why there's a lot of pressure on the spread between the 10-year and tranches of 30-year fixed rate mortgages. So there's a potential for this market to move really fast in the other direction, but we just haven't found that that precipice point where there's willing buyers in the market. And if the Fed's not buying, banks aren't buying, and we kind of sit at this stalwart kind of standoff right now where nobody's buying mortgage-backed securities. Consumers don't want to buy houses at 8% rates, yet there's still an inventory crisis. So home prices hold high. It's interesting.
Yeah, it definitely is interesting. And I'm glad you brought that up, because I think for some people, it's illogical that you wouldn't want a 7% mortgage rate, because, as a bank, you would think higher mortgage rates equals higher profit. But as you clearly stated, Clayton, that with these loans are not going to be held for a long term. At least that's the overwhelming belief, is that rates will come down eventually, and that everyone with a 7 or 8% mortgage is going to refi into a 5 or 6% mortgage, or whatever it comes down to. And then, a lot of residential mortgages don't have prepayment penalties or anything like this. And so that the only way that a bank makes money is by charging a higher interest rate up front, which is exactly what they're doing. So this is getting a little technical, but it really matters, because everyone wants to know where mortgage rates are going. And a lot of people just look at the Fed and they're like, oh, the Fed is doing this, the Fed is doing that. And that does impact things. But there is this whole other bond market, MBS market, that is playing a huge, huge role in mortgage rates right now. So hopefully this helps everyone learn a little bit about it.
And you brought prepayments an important topic. So mortgages are one of the only securities out there that do not have any type of prepayment penalty. It's a unique part of our U.S. housing economy. So if you're a bond trader or a fixed income investor, and you can get yield from corporate debt that has prepayment penalties and will have longer duration, that's a much better investment right now than the 30-year fixed rate mortgage that we know is going to get refied and MBS holders are going to get taken out. So like it's a complex factor there, but perhaps a better place to spend time than pontificating about where rates will go is like what happens when rates move. And Dave, one of the things that we're like thinking about, concerned, thinking, optimistic. It's a weird concentric circle right now. But if rates do move downward at a significant rate, that will be the precipice for more inventory coming to market because home buyers are home sellers. So as soon as the homeowner starts to feel confident in that move up decision or relocation decision, that repeat buyer is going to come back in the game, that will create more inventory because they'll sell their prior home. This is a good thing. It kind of lubricates the market and creates volume for the industry. But what it's also likely to do is put some wind in the sails of home price appreciation again. So if we see interest rates make a significant move beneath 7 into the 6s, and God forbid back into the 5s, I think we're going to see home price appreciation shoot back to the teens, and we're going to be back in a precarious situation where we're talking about affordability issues again.
Wow.
This time driven by the price of the asset, not so much the cost of the capital.
Interesting. Wow. And what do you think there is an inflection point there where it would get that high in appreciation in terms of rates?
There is an inflection point there.
But yeah, so I mean, I've seen some data from John Burns Real Estate or Research and Consulting, and Zillow's hits about 5.5%. I think is the sort of the spot.
I think that's too low. I think the market is in a full-on frenzy at 5.5%.
I kind of do too. That kind of makes sense.
I think we have a very functional housing economy at like 6%. And like if we dip back to the 5s, I think we are in frenzy land.
We're in trouble, yeah.
The only people like we keep talking about like these first-time home buyers. First-time home buyers are not anchored or hinged to 3% loans because they didn't get them like that. That's like they don't know. They might have heard about it, but like they're not like me who has like a 2 handle on their mortgage and it's never going to go anywhere.
Yeah, they weren't getting underwritten and like they saw what their monthly payment would have been.
Yep. So they'll be a little bit disjointed. Their nose will be a little bit out of whack, but they will. But they don't. They never had access to that cost of capital. I hope they don't ever again because we know what happens with 3% cost of debt means that we are in a world war with a national pandemic and some really bad stuff happening in our global society. And I mean, I don't want to forecast for that or bet for that because it's not a good thing.
Yeah, you and me both. Yeah, it's interesting though because I wonder though, like the big question to me is what you just brought up, and I'm glad you did, is that in traditional times, you see this scenario where when there's softness in the housing market, inventory goes up. This is clearly not what's going on in this market. And so your assumption, which I assume too, is that the reverse is going to be true, that when rates fall, the supply and new listings at least will start to increase. If it happens proportionately or not, I think is a really big question. If we're going to start to see maybe more demand or maybe more supply or how much supply comes online is still just such a big question. I could see exactly what you're talking about, or I could see in some ways, demand just coming back online without as much proportionate supply, which would lead to this sort of frenzy you're talking about as well. So I think it's a big thing to watch if and when rates do come down.
And if we're going to connect the whole picture and we see this environment where inventory starts coming back and interest rates are palatable, then we start to see an environment where the interconnectivity between the ownership market and the rental market starts to get more attention. So I think we're in a point right now where for first-time home buyers, home ownership has become inaccessible due to asset price and cost of capital. So potential first-time home buyers are choosing to continue as tenants and continue renting. In the last week, we've seen headlines in the Wall Street Journal. We've seen narratives from the National Association of Realtors about potential first-time home buyers extending their leases. I think there's even some YOLO type like headlines in the Wall Street Journal about people saying, I took that house down payment and went to Europe and this chose to travel. So there's some people, now I think we all know like how some of those like article sources are developed. It's not always like representative of the whole population,
right.
But like there's a narrative that some folks who had home ownership in their sites are like just backburnering that and they're continue on renting and like go on and live their happy life. But like that tide will turn, and at a certain inventory level and a certain interest rate level where those renters decide, hey, home ownership is now like back in my option pool and I'm gonna make that jump. So ultimately it all comes back to demographics, and we have a very strong demographic wave of 20-somethings and early 30-somethings that are either forming households today or will form households in the near future. And it doesn't matter what happens in the financial markets, the interest rate markets. We do not have housing supply to meet the demand of current demographics. So those people are either going to own or they're going to rent. There's going to be demand on either side, and there's going to be movement between the two. And that's going to be driven by interest rates.
Yeah, that's going to be very interesting for us, for our audience in particular, because I think it points to the idea that, their rents could start growing again too. We saw this crazy rent growth and it's really flattened out. But if this scenario that you're describing does unfold, it would point to further demand for rentals. I could definitely see that happening. There's definitely a logical path where that could happen.
The crazy thing with the rent market is it's a lot more feasible to change the volume of rental inventory faster than it is the volume of ownership inventory. So like multifamily developers have been able to bring a lot of inventory to market like really quickly at a pace that home builders cannot. So the rental market has more control of their own like future than I think the home ownership market does, for better and for worse.
Yeah.
Like overbuilding can happen fast, and like inventory problems can be created or solved. And I would defer to you, Dave, on where you think we are in that cycle.
Multifamily is not looking great. I mean, from an oversupply perspective, like we're seeing, I think in Q3 of 2023, we're going to see by far the highest delivery of units ever, at a point where it's already starting to soften. And it looks like we're going to have above average deliveries for, I don't have the data in front of me, but I think we have above average deliveries. And that just means new units coming online for at least another year. And so I think this is going to create a very interesting situation for multifamily where rents are already getting soft, cap rates are rising, there's an influx of supply. It's why I think on our show we've been saying that multifamily values were going to drop quite a bit. And I still think that's true, but probably a conversation for a whole other podcast.
Yeah, it's a complicated ecosystem, and multifamily, capital is important. And I think that some of the same banks who have been supporting multifamily developers and operators, both at development and lines of credit, are going to start feeling they have exposure to the office market as well. And there's going to be some pressure on access to debt and access to credit lines, and starting to see that pop up in the ecosystem already.
Definitely. It's honestly unfolded a little slower than I was expecting, but I think that will be a major story in 2024.
So we're not going to convert all the office buildings to apartments, right? Are we doing that?
I wish. I mean, they keep talking about it, but from everything I look at, it just says it's not really as feasible or as easy as people want it to be. So it would be nice. But before I go, Clayton, we're talking about stories for 2024, with your media business here. Are there any other stories in 2024 you're looking forward to or think are going to be particularly interesting?
Yeah, I mean, I think housing is interesting from a media perspective because it's a sector that goes through rapid change. And like our mission and vision is to provide the full picture to housing professionals. And I think as a media and data business, we're more important than ever in a period of change. So I'm excited to support our audience and support our users as we go through a volatile market. It's sad and disappointing that we've seen a lot of really qualified and really successful professionals exit the industry with volume down in real estate and mortgage. We're going through a wave right now where there's a pretty notable reduction in force in the number of people that are part of this industry. And that, it's sad and painful to watch, but it's also a really important inflection point in residential real estate. We're watching volumes come down, but we're also watching change at the national level. Some pretty headline lawsuits happening around real estate agent and broker commissions. And depending on the outcome of those, and there's some pretty varying viewpoints there, it could be a precipice for major change in the way that homes are bought and sold, and potentially could open the door to a very strong innovation wave.
I like the sound of an innovation wave. I'm not hoping for anyone to lose their shirt, but hopefully it's an innovation wave that raises all ships.
Yeah, no, innovation waves, there's winners and losers. But ultimately, this industry is built to support the homeowner, and the changes that we're seeing in market right now, as painful as they may be, do seem to point to a more efficient and economical solution toward homeownership. That's going to come with technology. It's going to come with faster and more free access to data and knowledge and information. But hopefully it creates a faster moving, more easily accessible housing economy that's great for homeowners, and then ultimately still is a very fruitful place to do business for lenders, real estate professionals, and folks like you and I who operate in the ecosystem.
All right, great. Well, I trust you all will be covering this closely. If anyone wants to follow Clayton and his team's work at HousingWire, you can find them at housingwire.com. Clayton, thank you so much for joining us. We appreciate it.
Dave, it's my pleasure. Thank you.
On the Market was created by me, Dave Meyer, and Kaylin Bennett. The show is produced by Kaylin Bennett with editing by Exodus Media. Copywriting is by Calico Content, and we want to extend a big thank you to everyone at BiggerPockets for making this show possible.